Money is a market, and it will never go away. It makes our lives too convenient. Think about how convenient money has made your life. If all the money disappeared, people would come up with a new money. If our memory of money was erased, we'd dream the concept of money right back up. It is apparently in our nature to create and use money. So money is a naturally occurring market. Money is a product. Money is a good. Money enables us to store value now and trade it for resources in the future. Money enables us to specialize in what we're good at. It makes trade so convenient that we can trade our specialty for money. This specialization that convenient trade enables drives innovation. For the purpose of this video, then, I'm going to sum up the benefit of money with one word: convenience. If we think about the purpose of our money and what it's used for, we can make the argument that money is the biggest market in our economy. Its magnitude supersedes any other market. This is because the money is good in exchange for all of the other markets combined. Most likely, you used money to exchange for your house or rent, your energy bill and utilities, your food, your transportation, and just about every other resource you use or own. Looking at it like that, we could say the money/currency market, which I'll also refer to as the monetary market, is as big as all of the other markets combined. To make this concept clear, I will use the United States monetary market as an example. The US dollar, aka USD, is good for all the other goods and services within the dollar economy. The dollar economy doesn't include the barter economy, or rare instances in which another currency is used within the US. The dollar economy is simply all the transactions carried out with dollars. Because the barter and alternative currency economies are only a tiny fraction of the US economy as a whole, they're not really big enough to say that the dollar economy is significantly less than half of the entire economy in the US. So, if all of the USD is good for virtually all the other goods and services in the United States economy, then the USD can be considered half of the United States economy. In other words, all the things we buy with our money is half of the economy, and the other half of the economy is the money itself, minus the tiny little sliver of the economy that is done via bartering. So that just goes to show how important the monetary market is. The monetary market is therefore worthy of cautious examination, as it no doubt plays a very important role in our lives. And in order to examine our monetary market, we need to examine the central banks, who've been tasked with managing the entire monetary markets of the countries they've been established in. Moreover, these central banks have been implemented in virtually every country around the globe. But before I continue with our examination of the central banks, I want to quickly note I'll be using the terms money, currency, and monetary products interchangeably. While technically they're not the exact same thing by definition, it shouldn't matter for this video's purposes. Now, to our examination of the central banks. In 1694, the first modern central bank was founded in England. Known as the Bank of England, it was tasked with being the sole issuer of England's paper version of tax demand currency. Tax demand currency is a currency that is demanded for taxes, including situations in which there is no other use for said currency, such as bartering. I came up with this term because there are no other terms that highlight this facet of the monetary market. Now, the Royal Mint could still issue coins as tax demand currency at the time, but the bank was issuing paper notes, which are a much more convenient form of tax demand currency because they are lighter and easier to carry. As a privately owned bank and a profit generating corporation, the Bank of England would lend its currency, known as the pound, to the government of England at 8% interest in order to help with King William III's war with France. In return, the Bank of England was allowed to issue banknotes that were accepted as payments for taxes, thereby making the banknotes tax demand currency. The banknotes were also required to be accepted for payments of debts, also making them legal tender. This generated a lot of demand for the Bank of England's new monetary product, as it was the most convenient way for the English to pay their taxes at the time. And because they were already paying their taxes with it, It was the most convenient way to buy other goods and services as well. Shortly after its establishment in 1694, the Bank of England expanded its operations by lending to private individuals and businesses. Eventually, the Bank of England would become the sole issuer of England's tax demand currency. Since then, this model of central banking, whereby a single bank has the sole right to issue all of the country's tax demand currency, has grown to encompass the entire global economy, with virtually every country in the world adopting this model of monetary policy. Since 1694, these profit generating central banks have been an ever expanding enterprise. To show this, I've created a visual of a world map that shows when each country established a tax demand issuing central bank that was or would eventually become the sole issuer of tax demand currency in that country. Yellow represents the country has a central bank established. The visualization starts in 1693 and progresses through the years until the current times. Note that this map is not compatible with the data for the countries of Somaliland or Kosovo. These countries are very small. Also note, this map does not adjust country borders for their time. Both of these issues are minor enough to not drastically change the overall pattern. Notice how the expansion starts off slow, struggles in some countries, then slowly gains a foothold, and finally starts to expand exponentially until it has covered the globe. So is this phenomenon based on the merit of this central banking system? Have we as a society mastered monetary policy and maximized the benefits of our monetary markets? Have we figured it out? Or could this expansion be the result of other causes? To answer that question, let's take a closer look at the merit of this monetary policy and what might cause such an expansion. Well, we know that since their inception, these central banks' monetary products have been granted the status of tax demand currency. And taxes are required on all transactions, not just the transactions that the tax demand currency was used for. That means you have to use the central bank's currency. It is indeed a legal requirement. If you have to pay taxes for all transactions, and the central bank's currency is the only currency you're allowed to pay taxes with, then you have to use the central bank's currency. So even if you'd rather not use the central bank's product, that's irrelevant. You don't have a choice in the matter. You have to use their currency. For example, in the United States, the official tax collecting body, known as the IRS, expects you to pay taxes even when you barter. According to the IRS, on bartering, quote, you must include in gross income in the year of receipt the fair market value of goods or services received from bartering, end quote. And the IRS will only accept the US dollar for tax payments. US dollar is also known as a Federal Reserve credit note and is issued by none other than the official central bank of the United States, the Federal Reserve, aka the Fed. As a result of this tax law, the dollar receives all of the tax demand within the United States, which in turn causes an increase in the dollar's value and purchasing power. Virtually every country around the globe has the same or similar laws in place that grant all of the nation's tax demand to the central bank's currency. So the tax demand currency status of the central bank's currency helps generate a lot of demand for its product. In order to understand how much so, I want you to imagine a situation where, let's say you live in the US, and maybe you even run a business here, and you don't like the dollar for some reason or another. You've decided you can live without it. Instead of using the dollar for your transactions, you've been transacting in every other way possible. All year you've traded by bartering and using silver coins, cryptocurrencies, and vouchers. You haven't had a single dollar or even a fraction of a dollar to your name the whole year. Then, at the end of the year, the IRS shows up at your door and requires you to figure out the fair market value of all your transactions for the year. And the IRS requires you to pay them taxes on the fair market value in dollars. Well, for one, It would be quite an inconvenience for you to figure up the fair market values of your transactions. And what is the main benefit of the monetary market again? Convenience. Then you have to sell some of your property for the dollar, a product which you've chosen not to use all year, thereby forfeiting your stuff for a product that you have no other use for. And then the process of finding people to exchange your stuff with for the dollars that you don't want is also an inconvenience. Now, if the monetary market is supposed to provide you convenience, and every form of money or currency in the US is inconvenient compared to the USD because of the tax laws, then the USD has an automatic competitive advantage over any would-be competition. This was made apparent in our imagined scenario without even considering the effects of other forms of taxes, such as sales taxes, property taxes, etc., all of which also have to be paid with dollars. And obviously, supplying goods and services and or alternative currencies in exchange for dollars and therefore demanding dollars creates a competitive advantage for the United States dollar. So, these tax laws render such a lifestyle choice inviable. And as a result, these same tax laws render alternative currencies inviable, because the regular use of alternative currencies would be too inconvenient and disadvantageous. This also means that attempting to supply alternative currencies would be uncompetitive and disadvantageous as well. Another observation we can make is that the United States dollar has a monopoly over the monetary market in the US. Or really, the Federal Reserve has a monopoly over the monetary market. There are no other monetary products that are being used conveniently to exchange for goods and services in the US, just the USD. Occasionally, someone in America will use crypto or precious metal coins for a transaction, but they still have to pay a sales tax in dollars, while the recipient of the alternative currency still has to record the income for income tax purposes. And virtually every other country has a monopolized monetary market as well. So these observations beg the question: is the central bank's monopoly status completely a result of this tax-driven demand? Or could it be that the dollar and other national currencies are such quality products that we've chosen to use them over all other competitors, and our imagined scenario is actually irrelevant? Is the dollar really that much better of a product than any would-be monetary competitor? Perhaps the government-assigned status of tax demand currency has its own merit. To answer this question, let's examine the effect a typical central bank's monetary product has on its economy. Because the Federal Reserve is the most powerful central bank in the world by far in terms of purchasing power, it makes sense to continue to use the Fed and its dollar for our examination. And every central bank in the world operates in a similar way. So, in order to examine the effect the dollar has on its economy, we will analyze how it works on the consumer end and the supplier end. So, the dollar does work, it gets the job done. I buy things with it all the time. It makes my life much more convenient than if I didn't use money. That's how it works on the consumer end, at least. But that's not the whole story of how the dollar works. How does it work on the supplier side, aka the Federal Reserve side? The next 7 minutes or so may get a little stuffy, but stick with it until the end, and I'll summarize it and simplify it and make it all make sense. I will also provide some visualizations to really help you get the idea of how this monetary system works. So, on the supplier side of the dollar, the primary way the Federal Reserve supplies new dollars for the economy is through something called an open market operation, or OMO. Whether it be actual paper money or just digits on a screen, these OMOs add new dollars to the economy by increasing the cash balance of a select set of financial institutions known as the primary dealers of the Federal Reserve, or just primary dealers. This increased cash balance is in exchange for treasury bonds these primary dealers already have. So the Federal Reserve is effectively giving these primary dealers money to lend to the government, just not in the particular sequence of giving them the money first for the primary dealers to then buy the treasury bond second. This is because if the primary dealer exchanges a treasury bond for cash, They could buy more Treasury bonds with said cash, knowing that in the future, the Fed will buy those Treasury bonds too. And if the Fed never buys those Treasury bonds from the primary dealer, then the primary dealer can just collect the Treasury payments. The New York Fed also buys mortgage-backed securities from the primary dealers, and even corporate bonds sometimes, effectively giving the primary dealers money to buy mortgages and corporate bonds in the same manner as the Treasury bonds. By buying and selling bonds from these primary dealers, the Federal Reserve is decreasing or increasing the base interest rate known as the federal funds rate. This sets interest rates throughout the entire economy and affects inflation. When they buy bonds, they increase the money supply and bid down interest rates. When they sell these bonds, they decrease the money supply and increase interest rates. As of now, the primary dealers are a group of 24 financial institutions that are subsidiaries to large international banks. These are privately owned branches of publicly traded banks. They trade financial securities such as stocks and bonds. But their main business operation is brokering and market making. A few of the primary dealers include JP Morgan Securities and Goldman Sachs LLC & Co. Foreign financial institutions such as BNP Paribas Securities and Deutsche Bank Securities Inc. are also primary dealers. You can't buy these primary dealer stocks on the public market like you can with the bank that they are a subsidiary to. For example, you can buy JP Morgan stock on the public market, but you cannot buy JP Morgan security stock on the public market. The other way the Fed creates new dollars is through the discount window. Yes, the Fed can change the reserve requirement, but this does not create new dollars like the discount window or OMOs do. The reserve requirement just locks or unlocks already existing dollars by letting banks lend a lower or higher percentage of their customers' deposits. And yes, the Fed also pays interest on excess reserves and reverse repo sometimes. But these interest payments do not really add new dollars to the economy either. They really just reduce the overall interest that the Fed collects from its other lending programs, which are the OMOs and the discount window. So, we are going to be focusing on OMOs and the discount window, and we're not going to focus on reserve requirements, interest on excess reserves, or interest paid on reverse repos, because for our purposes, we want to focus on the supply of new dollars. Although it is worth noting briefly that reserve requirements, interest on excess reserves, and interest paid on reverse repos do play a role in the banking sector, especially from a competitive standpoint. Now, in the discount window, the Fed issues, aka supplies, new dollars and lends it out at a slightly higher rate than the federal funds rate. Compared to OMOs, the discount window is available to a much wider set of financial institutions that meet certain criteria. The eligible financial institutions include commercial banks, savings institutions, and credit unions. The discount window also includes all 12 branches of the Federal Reserve, which we'll touch on here in a minute. It's also important to note that the Federal Reserve has stockholders, and those stockholders get paid legally required dividends, as one can see by reading the Federal Reserve's FAQ page on who owns the Federal Reserve. And while I may say at the beginning that nobody owns the Federal Reserve, with owns being in quotation marks, if you continue reading the rest of the document, it does say that the Fed has stockholders, and those stockholders do receive legally required dividends. The Federal Reserve Bank also has 12 branches spread out across the U.S., but the main branch, who is in charge of all the other branches, is the New York Fed. The stockholders of the New York Federal Reserve Bank are predominantly major banks like JP Morgan and Citi, but the stockholders are not limited to banks based in the U.S. Indeed, some stockholders of the New York Fed are from foreign countries such as China. So the Fed is generating profits for its stockholders by lending all the newly created money and paying out dividends on the debt payments it collects. The Fed also generates profits for its primary dealers by giving them newly printed money to lend out, and therefore providing the primary dealers with essentially free money that in turn generates the primary dealers' interest income as well as collateral for the debt that they purchase. Also note, the primary dealers often quickly flip these assets, such as treasury bonds, by selling them in the market, often to foreign countries, thus profiting by marking up the bond, hence the earlier mention of market making. But there are really no limitations on what the primary dealers do with the bonds they purchase or the profits they make. I should also note that the Federal Reserve's public mandate is to maintain a 2% inflation target and maximum employment. This mandate is overseen by the Federal Reserve Board of Governors, who are nominated by the President of the United States and elected by the Senate. There are 7 governor seats. However, the New York Fed's Board of Directors is nominated by the New York Fed stockholders. Interestingly, there is invariably one nominee for each of the directors' elections. There are 9 director seats. The New York Fed's Board of Directors then selects the New York Fed's president. Now, to begin to make sense of all that, let's explore the economic implications of this monetary system, so that we can determine if this is the optimal policy for the monetary market. The first implication stems from the fact that every time the central bank, such as the Fed, adds new money to the system, that money is lent out and therefore carries interest. This means that for any fiat currency in the world, the entire amount of it in the economy is owed back to the central bank plus interest. Yes, all of the money in the world plus interest is owed back to a central bank, and every dollar plus interest is owed back to the Federal Reserve. Note, I will sometimes use fiat currency and tax demand currency interchangeably. The definition of fiat is an authoritative or arbitrary order, decree. And since tax laws make the central bank's monetary product the de facto currency by decree of the law, I think it's an appropriate use of the term. The definition of fiat is not the absence of precious metals or the absence of tangible value, as one might think. So we've established that somebody owes all of your money plus interest to your central bank. Now, as the debt to the central bank gets paid off, it is removed from the economy. This removes the same amount of money as debt. This means there's not enough money in the economy to pay off the debt owed to the central bank. And because the debt owed to the central bank started off greater than the money available to pay that debt, when the debt and money are removed on a one-to-one basis, the ratio between debt owed to the central bank and money available to pay such debt increases. This makes it harder for institutions that the central banks lend to and every borrower downstream of this initial lending to come up with the money to pay off their debt. Indeed, if all of the money in the economy was collected for debt, there would be no money left in the economy, and at least one major financial institution that the central bank was lending to would have to default. As for the central bank, the collateral from the default belongs to them. And in case you don't believe me, for the next 30 seconds or so, I'll show you briefly here on the screen a quick overview of what the Federal Reserve has to say about their collateral. Here, I've provided a simplified visual demonstration of how this works. The green represents the money, the red represents the debt, and the little houses are meant to represent all the wealth in the economy. The size of the graph is arbitrary. Notice how the debt starts off greater than the money. Then they both contract at a 1-to-1 ratio as the debt gets paid off. The money supply is then extinguished, leaving no money to pay off the debt. The houses representing wealth outside of the red circle were able to pay off their debt, but the house that is in the red circle was not. So the house in the red circle represents the portion of the economy that was unable to pay its debt, and is therefore collateral that belongs to the central bank. That collateral is one way in which central banks profit. Now, in reality, the monetary system is not quite that simple, and we'll show a more accurate visual representation later. For now, I just wanted to show you the most basic mathematic principle of how central banks work. The situation of all of the money getting collected by the central bank is just a hypothetical that should not be expected to be a reality. Let's go back to our prime central banking example, the Fed. Instead of all of the money being removed from the economy, in reality, as the debt to the Fed gets paid off and the ratio of debt owed to the Fed to dollars in the economy, aka the red to green ratio we just saw, increases, it becomes more difficult for financial institutions to acquire the money they need to pay the debt that they owe the Fed. This results in some major financial institution defaulting and collapsing long before the money supply is extinguished. Usually, this financial institution will also owe institutions other than the Fed money as well. And many of those other institutions owed money by the defaulting institution need that money because they too are struggling to pay their debts. The whole thing results in a cascade of defaults by financial institutions. And when they go out of business, it wipes out their customers' funds as well. This might bring one to think of the FDIC, but we'll have to come back to that briefly a little later. Indeed, an analysis of what happened in the 2008 financial crisis, the Great Depression, and basically every other major financial collapse that happened under the domain of a modern central bank would reveal that this debt to money ratio was the primary underlying issue. This is not to completely dismiss other issues pertaining to these crises, such as risky loans or other risky economic behavior incentivized by certain regulations. You may also be aware of the large amount of risky derivatives trading for more recent crashes, which this debt-based economic environment incentivizes, that cause certain deeply connected financial institutions to lose big chunks of money that they needed for debt payments, causing them to go under sooner than they otherwise would have. Low fractional reserves cause greater leverage in the system, bringing collapses around sooner as well. No, these other issues aren't being dismissed, it's just that ultimately there was never enough money to pay the debt in the first place. And while analyzing each crash to prove this point beyond reasonable doubt would be rather extensive, and this video is already going to be long enough, I hope our systematic understanding of the monetary system makes it clear that this debt to money ratio is the overriding variable of the economic condition if this monetary system is in place. This argument should become more apparent as the video continues. So now I'd like to give a more detailed explanation along with a visual demonstration of the process we just discussed. Then I'll provide some visual simulations of this process playing out. So, as the debt coming due gets collected, the debt owed to the Fed is reduced by the amount that was collected, and the money supplied by the Fed is reduced by the same amount. So, the debt is reduced at a one-to-one basis with the money. But, because the debt was initially greater than the money, a greater percentage of the money is removed from the economy than that of the debt, causing the ratio of debt to money to increase. Or, to put it differently, there is a portion of the dollar economy that is unpayable debt because there is not enough money to pay it. And as the debt gets collected, the portion of the economy that is unpayable debt increases. This unpayable debt portion of the economy is represented here in red. As this unpayable debt portion of the dollar economy increases, it becomes harder for those who borrow, such as banks who borrow from the Fed and other banks, to acquire the money they need to pay off their debt. This drives the demand for dollars higher, and as demand increases, so does price. And what do dollars cost? Interest. So interest rates will tend towards the unpayable debt portion of the economy. Or at least the unpayable debt portion of the economy will be the most relevant variable in regards to interest rates. So when the central bank collects the debt, the unpayable debt portion of the economy grows. This means the demand for money is higher, which means money costs more, which means interest rates are higher. Now, when the central bank increases the money supply, it does so by making bids on debt. And if you're bidding for debt, you're bidding interest rates down, not up. If you don't understand why, just imagine trying to buy a bond from somebody at an auction. If somebody is willing to buy a bond that will pay them 5% interest, and you want the bond more than that person, then you offer to buy the bond for 4% interest. Now, since this monetary system starts with the assumption that money costs interest, and it supplies money by bidding interest rates, then this monetary system also assumes that at the start of said monetary system, the initial money supply starts with an initial interest rate, and therefore an initial debt and debt to money ratio / unpayable debt portion of the economy to go along with said debt. So building off of those assumptions, If we assume that interest rates will be the same as they were when the money supply gets back to what it originally was, here it was 33, which is just an arbitrary number I selected, then we also have to assume that the unpayable debt portion of the economy will be greater when the money supply returns to its original amount, because the debt equals the money plus the interest the money costs. And when we started to increase the money supply back to its original amount, we were starting with a higher interest rate, which means more interest per dollar was getting added onto the debt than there was debt per dollar initially. So the debt will be higher even though the money supply is the same. But then that nullifies our original assumption that the interest rates will be the same when the money supply returns to the original amount, because interest rates will tend toward the unpayable debt portion of the economy. But of course, the unpayable debt portion of the economy is greater now. So, in order to bid interest rates back down to the original rate, we have to increase the money supply beyond what it was originally. Now, I hope if you're watching this video, you understand that increasing the money supply creates inflationary pressure. So you can see how this monetary system puts us between a rock and a hard place. On the one hand, if you want to get interest rates under control and get the unpayable debt portion of the economy manageable, you end up creating inflationary pressure. And this inflationary pressure will tend to get worse as we go through these collection inflation cycles. So keeping the unpayable debt portion of the economy manageable eventually becomes hyperinflationary. So then avoiding hyperinflation leads to an overwhelming unpayable debt portion of the economy. So when the unpayable debt portion of the economy gets out of hand, either interest rates have to follow or the ratio has to get decreased because the Federal Reserve is decreasing the debt by collecting collateral in the economy at large, which means defaults are occurring across the economy, which causes economic depressions. And here's another look at what it was before we collected debt and after we bought more debt by issuing new currency. Notice only the debt expanded, the money supply is the same. Here I've provided a simulation of the annual progression of the debt and money within the dollar economy. This model assumes no major default and bailout situations that would lead to quantitative easing, and it also assumes no inflation target, such as the Federal Reserve's 2% inflation target. If you are unaware of what quantitative easing is, we'll get to that in a minute. Notice how the debt swallows the money. In this next model, we'll factor in the Fed's 2% inflation target and default crises that lead to quantitative easing. Quantitative easing is simply when the Federal Reserve or any central bank increases the money supply drastically in order to bid down interest rates, often to save the financial sector from collapse. Notice that even with consistent inflation, the debt to money ratio continues to expand. And the only way to temporarily get the debt to money ratio back under control is by printing enough money to create hyperinflation. In these final models, we're going to factor in quantitative tightening and stagflation. Quantitative tightening is when the Federal Reserve or central bank stops lending new currency and only collects the debt for a certain amount of time in order to get inflation under control by shrinking the money supply. Stagflation is when inflation stays elevated for a while. It's usually a result of money changing hands faster throughout the economy. One such example of money changing hands faster throughout the economy would be banks lending cash that they've had in reserves for a while. I hope you see why money changing hands faster drives prices higher. If not, we'll cover this more in depth later. But basically, the further the same dollar goes, the more that dollar bids prices up. So even with the shrinking money supply, you can still have stagflation. Often, central banks will start quantitative tightening because of stagflation. Notice here how quantitative easing not only leads to massive inflation immediately, but also leads to stagflation, which in turn leads to quantitative tightening, which then in turn leads to a rapidly increasing unpayable debt portion of the economy. Here I decided to run the same simulation again, but this time I have the scale size adjusted to the size of the debt bubble so you can see the ratio clearly the whole time. So you see the problem emerging here. The unpayable debt portion of the economy is slowly getting out of control. And to get it back under control, you have to increase the money supply so drastically that you're going to drown the economy in inflation. And the only other way to shrink that red circle and get the unpayable debt portion of the economy back under control is to allow a massive percent of the economy to default on their debt. And either of those two options create economic depressions. But remember, the central bank gets to collect the collateral. Finally, here we have the same demonstration in the form of a line chart. It may take a minute to become visible. So we see here that by design, the dollar economy and the rest of the global economy has either uncontrollable inflation or uncontrollable growth in debt and interest rates. "2008 was a good example of quantitative easing, or QE, where the central banks increased the money supply by many multiples to temporarily save the financial system from collapse. But eventually, the Fed must allow the cascading banking failures, because eventually, attempting to stop this from happening will result in the hyperinflationary collapse of their currency. And for the central banks at the helm of the empire, there is much greater incentive to collect the collateral than there is to risk hyperinflating their currency to death. And the Fed is at the helm. We should not expect the Fed to do the same thing to the dollar that the Central Bank of Venezuela did to their bolivar. The Fed is the command and control center for this global central banking empire, as displayed by the dollar's global purchasing power. The Fed, and other first world central banks for that matter, have a lot more to lose by hyperinflating their currency to death than the Central Bank of Venezuela. And the central banking empire as a whole loses a lot more if the dollar goes down compared to if a less powerful currency, such as the bolivar, goes down. To the central banking empire, the dollar is crucial. The bolivar is scrap. So the Federal Reserve is incentivized to let the cascading banking failures occur instead of risking hyperinflating their dollar to death. Therefore, the collapse of many major banks will result in the disappearance of customer funds, which will spur business defaults, large and small alike, as well as mortgage defaults. And because money's becoming scarce, people will start taking the money they can get out of other markets, causing disappearing investment funds, such as retirement funds, and so on. This is not financial advice. And what you note, in 2019, the federal funds interest rate spiked from the Fed funds target range near 2% all the way to about 10% overnight. And while the Federal Reserve said it wasn't QE, they did increase the money supply drastically in order to bid the Fed funds rate back down to 2%. Because of its relevance to the 2019 credit event, I think it's a good time to note that when a large sum of debt comes due is likely to determine when the financial crisis occurs. So it's the debt due now to money ratio that has the biggest impact on when defaults start to occur or when interest rates start to spike out of control. Indeed, on September 16, 2019, a large amount of Treasury debt came due, and at the same time, corporate taxes came due, so banks removed money from their reserves to pay taxes, leading to an overwhelming amount of debt coming due relative to the amount of money available to pay it, which caused the federal funds rate to spike to 10% overnight from 2%. This means that some banks and financial institutions were so desperate to pay off their debt coming due that they were willing to pay 5 times the expected interest rate in order to borrow money to pay it. Now, the Fed was able to print enough money to bid down interest rates this time, but with each subsequent debt shock to the system, the unpayable debt portion of the economy is likely to be significantly bigger than it was last debt shock. This is because the unpayable debt portion of the economy is continuously compounding, as we demonstrated earlier. And this means it will require a greater percentage increase in the money supply to bid down interest rates each subsequent debt shock, so the next time this happens, the Fed might not be able to bid down interest rates without hyperinflating to zero. So we see that the central banks turn the economy into something akin to a game of hot potato, where the potatoes are the debt, and in the end there will be more losers than winners. We could also look at it like a game of musical chairs, where the chairs are the money and the people are the debt. Eventually, in this economy, most of the people lose everything, from the assets they didn't pay off to the cash they have in their bank account. Now, some people might say, well, my bank is FDIC insured, so I'm okay. But the FDIC's funds are limited to what the Fed puts in the economy as well. Nobody is allowed to issue new dollars into the economy besides the Federal Reserve. Not even the FDIC. And actually, the FDIC's assets are barely over 1% of what they insure. Now, one might see that the government plays a role in all of this, and while that's obviously true, it's important to note that the government is the debtor. The lender tends to have the upper hand in the lender-debtor relationship. So from this perspective, it's not unfounded to speculate that most government actions, including regulations, are approved by, or even dreamt up by, their lender, the central banks. Given the information we have now, it would be biased to not entertain this perspective on the government-central bank relationship. But for now, let's see if continued analysis of the monetary system reveals with more or less certainty if this perspective is appropriate. So the first implication of this central banking monetary model we observed was the inevitable creation of a financial and economic bubble that will pop, resulting in massive defaults across all economic sectors and a probable economic depression. The second implication we can observe regards the purchasing of treasury bonds. At the initial implementation of this monetary system, if the government tried to collect enough taxes to pay off its debt, then the money would quickly dry up, bringing around a debt collapse sooner and leaving some other sector of the economy unable to pay its debt. But now, at this stage of the debt-based monetary system, the government can't simply pay off its debt anyway. Over half of the dollars the Fed supplies are created by buying federal treasury bonds. Without the Fed buying new government debt to pay off old government debt, the government would default on its old debt. Even if the government cut back on spending drastically, it would still have overwhelming debt payments coming due. In 2024, for example, $7.6 trillion of government debt came due, but the government only collected $4.92 trillion in tax revenue. Imagine how quickly the money supply would shrink and how worse off the rest of the economy would be in regards to their ability to pay off their debt if the government tried to pay off its debt as it was coming due, instead of refinancing their debt and keeping their share of the debt burden, all while keeping the money supply somewhat stable. Put in other words, think how much faster the green circle we showed earlier would shrink if the government didn't sell new debt that the Fed can buy and thus keep the money supply, aka the green circle, sufficient to keep the red circle from overwhelming it for the time being. Think how quickly the unpayable debt portion of the economy would grow. So why doesn't the government just abolish the Fed and start issuing the dollar themselves? Well, for one, the government would still have debt coming due from foreign countries. But now, it wouldn't have the Fed to refinance its debt. The government would be in a much more precarious position because it would be depending on foreign countries to refinance the debt. And the foreign countries would recognize this risk and have less incentive to buy the US government debt. Sure, the government could just print enough dollars to pay off its debt, but that would be hyperinflationary. For one, printing that much money, and thus increasing the money supply that drastically, would be hyperinflationary in of itself. But then we must also consider that this new money printed to pay off the old debt wouldn't be owed back to anybody. This gives these new dollars the ability to go further and thus be more inflationary. Think about how much more likely you are to be careful about how you spend your money when you owe it to somebody in the future versus when you don't. These new dollars, which have just been let off their proverbial debt leash, will roam further. With these new dollars no longer owed back to the supplier, no longer metaphorically chained by debt to the supplier, if you will, these dollars will change hands more often and go further. The further the dollar goes, the more inflationary it is. The rate at which money changes hands is known as the velocity of money. And this increased dollar velocity would outweigh the reduction in inflationary pressure caused by any reduction in the money multiplier effect, which such a policy change may lead to. This is because all of the money created by banks lending out deposits is also money owed back to the supplier that must be spent carefully. So, this hypothetical policy change will result in hyperinflation. For those who don't know, the money multiplier effect explains what happens when banks loan out a percent of customer deposits. When an individual or business receives a loan or payment, they will often deposit much of that loan or payment at a bank. The bank will then loan out a percent of this deposit. Current market conditions put the percent of customer deposits loaned out by banks at 80% on average. This means banks on average only have about 20% of customer deposits on hand at any given time. This practice of lending out a percent of customer deposits is known as fractional reserve banking. The thing about this money multiplier effect caused by fractional reserve banking is that it too is really just like money changing hands. The difference between when money changes hands through loans versus cash purchases is that when money changes hands via loans, it is still on a debt leash. It has less freedom to roam and is less inflationary. So the effect this policy change would have on prices due to the increase in the money velocity it causes would be greater than any reduction in prices caused by a reduced money multiplier effect. And while we're discussing it, I might as well cover fractional reserve banking and the money multiplier effect. Something important to consider with the money multiplier effect is that it comes with a debt multiplier effect, because the money multiplier effect is caused by banks lending money. So it's still all owed back to them, plus interest. And as money makes its way back to its original source, the money multiplier effect is reduced commensurately. So when somebody pays off their debt to the bank, the debt to money ratio of that bank's community grows, just like with the Fed. So that red-green circle graph we watched earlier is really happening all throughout the economy at all the banks as a result of the money multiplier effect. And the money multiplier effect is reduced most when money makes its way back to its original source, the Fed, to pay off debt to the Fed. Explaining once again how any attempt by the government to pay off its debt to the Fed would reduce the money supply drastically, leaving a huge portion of the economy unable to pay their debt. And the government probably wouldn't succeed anyway. All of the banks that create the money multiplier effect are just like the Fed and other central banks, except they can't issue new currency, and they can default. And when they default, that money is wiped out. And the money multiplier effect is reduced commensurately. The bank doesn't have all of the depositor's money because it's lending a percent out. And so there's a good chance, as markets start going down and withdrawals start increasing because individuals need the money to pay off their debt, that banks go under. And remember, these banks are all lending to each other, and so when one goes down, it's likely another goes down. And on a related side note, I'd like to ask you a quick question. How many people do you know that haven't paid off their mortgage but have money in their 401k? So if the government supplying the currency isn't a good option and paying off the debt is inviable, then what happens if the government defaults? Well, once again, the demand for government debt goes down and the government's ability to finance itself gets weaker for the same reasoning that abolishing the Fed would hurt the government's ability to refinance itself. Now for fun, let's consider what would happen if there was some sort of global debt forgiveness, as I've heard some people speculate. Well, now you're just letting some percent of the money, if not all of the money, that used to be previously leashed by debt off its leash. This would be hyperinflationary. So what about changing the tax demand currency to crypto or precious metal? Well, that would probably upset a lot of people who worked hard for their dollars and were counting on them. You can't just say dollars don't count anymore and not expect backlash. And if you know what CBDCs are, I'm not referring to those when I say crypto. You'll see how they fit into this video's argument by the end of the video without them having to be covered directly. And if you don't know what CBDCs are, don't worry about it. They're not really relevant for this video. Now, there's recently been some talk of the government paying off its debt with crypto or precious metals. Paying it down a very small amount like this might be possible, but paying it off completely like this is entirely unrealistic. Even if the crypto and precious metals market boomed to prices so high that Americans have $35 trillion or more worth of these assets, and then the government confiscates it all from their citizens, what happens when the government tries to sell it for dollars, which their debt is supposed to be paid in? The price of these assets would crash as the government sells it, and as a result, the government would end up with only a small percent of that original $35 trillion plus price tag, which is the current amount of the government debt at the time of this recording. And since the demand of American citizens for these assets would be zero or near zero, the reduced demand would exacerbate the crash even more. As for the government's lenders accepting the crypto or metals at market value in lieu of dollars, well, for one, that's highly unlikely. This would be far from ideal for the government's lenders because these assets don't have the tax demand of the entire U.S. economy like the dollar does. So they would be a much less secure form of monetary product, if you can even call these assets monetary products, since they can't really compete with the tax demand currency in the monetary market. And if this compromise were made by the government's lenders, it would greatly reduce the demand for the government's debt because it would signal that said debt can no longer be paid with the government's tax demand. And if the government debt is no longer to be paid in dollars, or such is anticipated, then the demand for the dollar decreases, hurting the value of the dollar. So you see, even when we try to spin this scenario of the government paying off its debt in any of the most favorable ways we can think of, the math still doesn't math. It still doesn't work. So what about backing the dollar by gold or some other commodity? Well, this is a huge topic that deserves a digressionary interlude from the chapter's stated purpose. So prepare yourself for a long side tangent, please and thank you. So now let's discuss gold backing and the gold standard. The last time the US was on the gold standard was from 1900 to 1933. In the year that the Fed was established, in 1913, the Treasury transferred $143 million worth of gold to the Federal Reserve, about 7.5% of the Treasury's holdings at the time. At the same time, the dollar became a Federal Reserve credit note, so all of the newly issued dollars, which were now being supplied by the Federal Reserve Bank, were being lent, and therefore were owed back to the Fed plus interest. These same dollars were good in exchange for gold too. I hope you see where I'm going with this. They were buying treasury bonds with debt-based gold-backed dollars. In other words, they were buying government debt that was good for gold with dollars they were printing. The Fed was compounding interest into the Treasury's supply of gold. And by 1932, the Fed had $3.5 billion worth of the Treasury's gold on its balance sheet, which at that point in time in history was about 83% of the Treasury's gold. Then, in 1933, the U.S. government ordered the confiscation of nearly all of their citizens' gold in exchange for dollars. Individuals had to turn nearly all of their gold coins in to the Federal Reserve in exchange for dollars. At the same time, the U.S. came off the gold standard, so dollars were no longer good in exchange for a fixed amount of gold, and gold lost all of its tax demand. At this same point in time, the Federal Reserve exchanged the gold it had for Treasury debt denominated in dollars. This fits a recurring phenomenon which is of big banks, including central banks, exchanging gold for more control over the tax demand currency. You essentially exchanging gold for tax demand. So we see that the last time we were on the gold standard, it did not stop the tax demand driven monetary monopoly from supplying 100% of the new money by lending it with interest. And what else would you expect from a monopoly? Econ 101 states that a monopoly maximizes its economic profits by reducing the supply below equilibrium. And central banks do this by lending all of the money, creating a shortage in the supply of money relative to the debt. And they maximize their profits by collecting the collateral. But does that last example of the gold standard completely dispel any argument for it being the optimal monetary policy? Let's dig a little deeper. So notice, no country in the world is still on the gold standard. This means that 100% of the gold tax demand currencies, aka gold fiat currencies, ever throughout history have failed. Precious metal fiat currencies that were in the form of coins have always eventually been melted down and diluted with other metals, and is shown in the most recent implementation of the gold standard just discussed, known formally as the International Gold Standard. We essentially saw it used as a gold heist. Now let's dive deeper into the International Gold Standard because it fits into an interesting pattern pertaining to the consolidation of the current central banking empire. Countries kind of came onto the International Gold Standard in a staggering fashion and came off in a staggering fashion. But basically, the International Gold Standard was in effect from the late 1800s into the 1930s, when almost every central bank of the world's major economies was on the gold standard at the same time. Interestingly, the International Gold Standard was in existence at a point in time when many of the world's central banks were still privately owned. Then, most of these countries' central banks that were on the gold standard came off of the gold standard in the early 1930s and then became government owned banks in the 1940s. This departure from private ownership interestingly began happening right at about the same time as an event known as Bretton Woods. At Bretton Woods, the Allied countries of World War II set a new global monetary standard, which made the Federal Reserve's dollar the world reserve currency. This is interesting because not only was the Federal Reserve at the helm of the world's largest economy, the United States economy, but it is also one of the few central banks still privately owned today. The world reserve status essentially made the United States dollar the primary medium of exchange for all other fiat currencies. In other words, if the Bank of England were to trade with Japan, then instead of buying the Japanese yen with the Bank of England's pound, the Bank of England would buy the yen with the US dollar. So the Bank of England would need to buy plenty of US dollars with the pound, driving the demand for dollars while supplying the pound to do so. This gives the dollar a huge advantage over the other fiat currencies around the globe. Virtually all of the countries accepted this policy. In return, the United States agreed to make the dollar exchangeable for a fixed amount of gold to the other central banks. The Bretton Woods Agreement did not extend to private individuals, as only other central banks could exchange dollars for gold. The U.S. ended this agreement in 1971, despite that the U.S. dollar is still the world reserve currency. This global monetary market dominance associated with the U.S. dollar's world reserve status would extend itself into what is known as the petrodollar as well. While the petrodollar created a lot of demand for the dollar, said demand is subordinate to the world reserve title. So while the petrodollar is not irrelevant, it's not worth diving into the specifics of because the magnitude of its impact on monetary markets is captured within the scope of the world reserve status. And by giving the United States an upper hand over other countries in terms of purchasing power, and therefore overall power, the world reserve status was an underpinning for the petrodollar. But the petrodollar is worth a brief mention to let those who are aware of it know that it has been accounted for, and to make those who are unaware of it aware so they can decide to look into it if they wish. Now, within the central banking empire's expansion, the central banks appear to have siphoned gold out of the market into their own hands during the International Gold Standard, and only after the gold supply was completely controlled by the central banks did they relinquish their private ownership. And also, this relinquishment of private ownership of central banks in most countries came only after the central banking empire had consolidated its purchasing power into the dollar, which is issued by the Fed, which is still privately owned. You see how that played out? The pattern is that at first, the privately owned monetary empire, known as central banks, expanded until they covered the globe. Then, once the empire had covered all of the world's major economies, the process of consolidating global purchasing power really gained traction, including the gold heist. If you monopolize the monetary market, even gold and gold backing can't be sound money, as we just clearly demonstrated. Monopolies are always a problem. They will always reduce the supply below the demand in the market in order to maximize their profits. Always, by their nature. Because there's no competition to keep them in check. So they make more profits by reducing the supply, which drives the prices up because there's no competition in the market to increase the supply and undercut the monopoly. And this particular monopoly is driven by taxes on bartering and private currencies that must be paid in said monopoly's product. Simple supply and demand from would-be monetary competitors to the tax demand monetary product. And since we're already in a digressionary interlude, let's quickly look at the popular argument for abolishing fractional reserve banking. Do you keep your money at a bank? If so, why? Does the bank provide some sort of service? Do you expect them to provide that service out of the charity in their hearts? Or do they need to eat too? Perhaps they could start charging you fees instead of making their bread by earning interest income. Maybe some banks would, but the problem is that the Federal Reserve sets a market standard for fractional reserves, telling banks the least amount of reserves they can hold. This means that one entity is setting the standard for the rest of the market. Before 2020, the reserve requirement was 10% for a long time. In 2020, however, the Federal Reserve dropped it to 0%. Banks, especially big banks, don't tend to deviate too far from the reserve requirement, as we saw earlier when we showed that the typical bank has 10 to 20% of the customer's deposits on hand at any given time. Think about what setting it to zero means for the health of the financial system. But let's not get too far off topic. Anyway, banks have to compete with one another, and if most banks are making interest income on nearly 90% of customer deposits, a bank playing it much safer and making interest income on only 50% of the customer's deposits is going to grow at a much slower pace than the 90% bank, putting it at a competitive disadvantage. That is, unless they advertise their risk adversity and thus gain more depositors that way. But when most people think the FDIC has them covered, and or that the Federal Reserve's requirement is sound, there is little point in advertising it. Really, most people don't even think about it anymore in this day and age. The central banking empire has created a false sense of security about the stability of financial markets by propagating deceitful ideas and beliefs about money into the world. If you think about it, the propaganda campaign would be easy to fund for the central banking empire and necessary for the central banking empire. And maybe it sounds conspiratorial to some to say that, but what else would you expect from such an organization? That is indeed what you should expect at this point. So now, back to why we should not abolish fractional reserve banking. If Billy and Sue down the street are comfortable with a bank lending out 99% of their customers' deposits so that the bank can earn enough money to pay them a nice percent on their CD, who is anybody else to tell them they can't take the risk? If there wasn't a standard set, you could easily go find a bank offering higher fractional reserves. There would simply have to be enough demand in the marketplace for the higher reserves to justify the business operation. Maybe Billy and Sue go take the risk, and you go find a bank that only loans 30% of customer deposits, taking much less risk. Or maybe you go to a bank who has 100% of its customer deposits and makes its money by charging fees. As long as the bank isn't fraudulently lying to you about its operations, both parties should be allowed to act within their own agency and risk tolerance. If two parties consent and you tell them they are not allowed to make the consensual transaction, then you are acting dictatorially. The problem with fractional reserve banking is that the standard is set by one entity, and the current set standard increases risk, as one can probably sense when considering 1. It's currently 0, and 2. It's set by an organization who benefits from a shortage in the money supply, which extra lending leverage, caused by reduced fractional reserves, will exacerbate when the money multiplier implodes. The third implication of the current monetary model we'll observe pertains to the housing market. The point should be starting to get pretty straightforward here. The Fed issues currency and buys mortgages with it via mortgage-backed securities, driving up the prices of homes. But not enough money exists to pay off all the debt, which includes the mortgages. Many people default on their homes, especially if their bank has already lost all of their money. This supply of foreclosed on homes hitting the market crashes the housing prices. And when people default on their mortgages, the Fed collects the homes as collateral. The final implication of this monetary system we're going to look at is one I find particularly interesting. This one involves the purchasing of corporate bonds by the primary dealers. The same default and collateral repercussions and boom and bust repercussions that we saw in the other implications apply to the corporate world. But also at play is the direct role the Fed, and its primary dealers especially, get to have in selecting who is successful in the private sector of the economy. Because even though the corporate bonds have to be paid off by the corporate borrower is still receiving an advantage over its competition in terms of capital. Most available capital comes in the form of debt, thanks to the monetary system in place. The amount of capital that the Fed can print gives the borrower financial leverage over its competition. Competitive leverage, if you will, that was created from thin air and without limitations to its size. This practice of printing large sums of money and loaning it out to corporations inevitably creates industry giants so big that the corporate recipient of such capital begins to monopolize their industry. If a few firms in the industry receive similar loans from the Fed, the tendency is for the industry to become an oligopoly. Once this oligopolistic corporate environment is created, these corporate giants can then wield great power and influence over their industry. That is, as long as they pay off their debt. And as long as the central banks don't select somebody else. Historically, the lending of these central banks to private institutions has played a significant role in our global economy. Owners of these central banks were also significant in other industries. John Jacob Astor, for example, who was originally from Germany until age 16, then lived in England until 21, is widely credited with owning the first monopoly in America, known as the American Fur Company. Before that, however, he was an owner of the first central bank in the United States, which is known as the First National Bank of the United States and was founded in 1791. That central bank would lose its charter in 1811 but regain it in 1816. Astor bought stock in the rechartered Second National Bank of the United States as well. This is just one example of a central banker creating a monopoly in an industry outside of the monetary market. Astor is said to have died the wealthiest person in America in 1848. Another example would be Stephen Girard, who bought the stock of the First National Bank of the U.S. after it lost its charter as a central bank in 1811. He called it the Bank of Stephen Girard. Girard's bank was the biggest source of government credit in the War of 1812. Girard's bank was lending the government banknotes that it was printing. The government supported Girard's bank's currency by accepting it for debt payments. Interestingly, the next central bank was re-established about a year after the war ended. Girard became one of the biggest stockholders. Seem coincidental? Girard's bank would obviously become one of the biggest banks in the private sector. Girard then financed the Schuylkill Navigation Company, which gained a monopoly on transporting coal. Girard is said to have died the wealthiest man in America when he died in 1831. Interestingly, most of his fortune was donated to causes related to education, showing early signs of interest and influence the central banking system has in the education system. Another example of the stockholders of these central banks in America becoming and or creating industrial tycoons is Alexander Brown. Alexander Brown was a director of the Baltimore branch of the First National Bank of the United States. During this time, his family business, Brown & Sons, developed rapidly, exporting tobacco and cotton. Brown was then instrumental in the implementation of the Second National Bank of the United States and was a large stockholder. In 1822, a few years after the central bank's reestablishment, Brown & Sons had monopolized the shipping trade between Baltimore and Liverpool, one of the biggest trade routes in the world at the time. Interesting side tangent on Brown. It's noted that there is no evidence that he was involved in the Irish Rebellion in 1798. Yet, he still went into hiding afterward and brought his family to America with him in 1800. Now, I'm no expert on the Irish Rebellion, but I noticed management of Ireland's state financing moved to London in 1800. My guess is that the Bank of England was involved. Now, forgive me for any misrepresentation here, as I just came across it and decided not to vet it for time's sake, but you'll notice as we continue a recurring theme of central banking benefiting from conflict. My future instances will be vetted. Brown's eldest son, William, formed Brown & Shipley in 1825, which became a huge player in banking. His other sons had set up Brown Brothers Company in 1818. Brown Brothers has been significant throughout history in many ways, as we'll come back to. In 1827, Alexander and his second oldest son, George, got into the railroad industry, which was obviously an oligopoly. George was heavily involved in the Baltimore and Ohio Railroad Company. Baltimore and Ohio Railroad Company was, as we'd expect, a huge success, and it spun off new figures of wealth and prominence, including John Hopkins and E.H. Harriman. Harriman was a financier and a railroad tycoon. Both the Brown and the Harriman family's wealth continued multiplying through their generations. Brown & Sons would eventually merge with Harriman Brothers & Company to form Brown Brothers Harriman & Company in 1931. Brown Brothers Harriman & Company was shown to be a stockholder at the New York Fed in 2020. This is quite interesting, since William Averill Harriman, the original founder of Harriman Brothers & Company, and a key figure at Brown Brothers Harriman, had many of his business's assets frozen for funding the German war effort during World War II. Much of this funding was funneled through the Union Banking Corporation, which was a joint venture with Morgan Guaranty Trust, now known as Chase Bank. From Union Banking Corporation to a man named Fritz Thyssen, a wealthy German industrialist and banker, and finally, the German dictator, whose name I don't want to use because I'm not sure if it could be an excuse for certain platforms to remove this content. Thyssen, one of Germany's dictator's biggest supporters, detailed this funding in his book called I Paid, insert Germany's dictator's last name here. But William Averill Harriman's support for the German war effort didn't stop him from supporting the USSR in their war effort as well. Before the war, William Harriman, through his corporation, Georgian Manganese Company, revitalized the Russian export economy following its collapse after the Bolshevik Revolution. His dealings were technically illegal, and while the State Department and Department of Commerce were both informed of these illegal deals, neither of them decided to pursue this investigation. Officials at the State Department ultimately decided that, quote, there are certain and very definite reasons why I consider it very unwise for the department to initiate any investigation with respect to the reported manganese concession. End quote. Any further discussion on the reasoning behind this was to be discussed orally as stated in the same document. Then, during the war, while Harriman's bank was funding the Germans, Harriman was appointed the Lend-Lease administrator for the Lend-Lease program, which was created during World War II for the purpose of allowing the United States to lend or lease war supplies to nations deemed vital to its defense. Harriman was appointed administrator a few months before the Germans invaded the Soviets. And while the Lend-Lease program only specified that defense articles be shipped, records show that quite a bit of agricultural equipment and quite a bit of non-military industrial equipment was sent to the Soviets through the Lend-Lease program. Also interesting is Prescott Sheldon Bush's partnership at this company. Prescott was President George Bush's father, but that's besides the point. And while we're on the topic of the first central banks of the United States, I can't help but briefly take us down an irresistible side tangent. It appears that at least some of the men we call founding fathers had ties to the Bank of England even during the American Revolution. For example, George Washington's stock in the Bank of England and his subsequent failure to veto the first central bank of the United States. These same men were involved in the federal ratification of the United States Constitution, which was only supposed to be amendments to the Articles of Confederation. The federal ratification was also arguably illegal at the time. The Constitution then enabled these same men to set up a central bank in the United States, just like that of the Bank of England, thereby expanding the central banking empire. It's important to remember that the Bank of England would have been compounding interest in the English economy, into the English government, into the English monarch for nearly a century at this point in time. So England would have probably been controlled by the central bank, not the monarch. The United States federal government racked up about $75 million in debt during the Revolutionary War. Obviously, $75 million was a lot more back then than it is now. This debt was known to at least have played a part in the calling for a constitutional convention. It's well known that some of the stockholders of the first two central banks of the United States were from foreign countries, although the percent of those stockholders that were from foreign countries is in dispute. So let me ask you a question that you don't have to answer yet. From a bird's eye view, does the American Revolution appear to have been about gaining independence from a monarch, or about a central bank cornering a monetary market? But the root of all this goes deeper than the central banks. From 1837 to 1913, the United States did not have a central bank. However, they did still have tax demand currency. There were a few different monetary systems that came and went throughout this time, but they all involved a select few banks basically being allowed to issue tax demand currency and therefore benefit from the tax demand. And in comes Rockefeller. At the end of Rockefeller's career, he bragged about never needing credit. But the beginning of his career was very different. Early in his career, he was quoted saying, "In the beginning, we had to go to the banks almost on our knees to get money and credit." And this was the key to Rockefeller's success: securing loans and credit from banks, especially that of which could issue new currency. And this is how Rockefeller bought out refinery after refinery and consolidated the industry under him and Standard Oil. In regards to the purchase of one particular refinery, Rockefeller is quoted saying, "It required many hundreds of thousands of dollars, and in cash. Securities would not answer. I received the message at about noon and had to get off on the 3 o'clock train. I drove from bank to bank, asking each president or cashier, whomever I could find first, to get ready for me all the funds he could possibly lay hands on. I told him I would be back to get the money later. I rounded up all of our banks in the city and made a second journey to get the money, and kept going until I secured the necessary amount. With this, I was off on the 3 o'clock train and closed the transaction. End quote. At one point, Cleveland's financial markets could no longer handle Rockefeller, and he started procuring credit from bankers in New York, albeit with some struggles, as the New York bankers were still more comfortable in the railroad industry. Rockefeller's demand for capital even led him to become a director at the Ohio National Bank in 1868, even though he never attended bank meetings. As per policy at the time, all nationally chartered banks, such as the one Rockefeller was director of, were able to print banknotes that were good for debt and taxes. These national banks were allowed to issue 90% of the value of the Treasury bonds they deposited at the U.S. Treasury in their own banknotes. Eventually, an extremely wealthy banker named Stephen V. Harkness would move to Cleveland and set up Euclid Avenue National Bank. Stephen V. Harkness would buy $100,000 worth of equity from Rockefeller in 1867. This provided Rockefeller a nice chunk of capital, which he didn't have to pay back with interest. Conservatively accounting for 2% inflation, this would have been a value of over $2 million in today's value. And the Harkness connection would open the door to a lot more capital from the various banks Harkness was a director of, along with Harkness's other banking connections. Shortly after this Harkness connection was made, Rockefeller's net worth really started to explode. In 1872, Standard Oil raised $3.5 million in capital by selling stock, much of which was sold to various bankers, including Truman P. Handy, Amasa Stone, and Stillman Witt. These various bankers had been involved in financing various railroads, steel companies, and even Vanderbilt. In 1873, a 6-year economic depression began, and Standard Oil began buying up refineries left and right. Standard Oil started to monopolize the oil industry at that time. Rockefeller attributed this astounding success during the economic downturn to unparalleled access to bank credit. Little is known about Harkness, but he died worth $150 million in 1888. 25 years later, after immense growth and after inflation, Rockefeller's estimated net worth was $900 million. If Harkness' net worth had continued to grow and expand in those 25 years, he would have been in Rockefeller's ballpark. But little is known about the initial capital behind Rockefeller. Interestingly, we see a lot of Harkness's wealth getting donated to education after his death, this time through his son Edward Harkness. It's as if these bankers have a vested interest in controlling information. To sum up the rest of this time period with some efficiency, I'll just say that Cornelius Vanderbilt appears to have had a credit ringer in Drexel, Morgan and Company at the time when his net worth was growing at its fastest pace, which was in the 1860s and the 1870s. Drexel Morgan & Co. would eventually become J.P. Morgan Bank. Andrew Carnegie appears to have had a credit ringer when his wealth was growing at its fastest pace in a man named David McCandless. McCandless was the VP of Exchange National Bank and a partner at Carnegie, McCandless and Company, which would then form Edgar Thomson Steel Works. McCandless was highly respected amongst creditors. Eventually, J.P. Morgan bought out Carnegie's steel operation and turned it into U.S. Steel. Carnegie received $225 million for the deal. Carnegie then donated much of this wealth to libraries and universities in what appears to be another influx of banker capital into the education/information markets. And while the education and information markets are a rabbit hole for another day, I think some of you all can see where I'm going with this. When Morgan died, it was revealed that he only owned about 20% of J.P. Morgan Bank. Morgan had originally inherited his wealth from his dad, Junius Spencer Morgan, who in turn made most of his money when partnered with George Peabody. Yes, the Peabody, who was an international banker who once needed a loan from the Bank of England. Interestingly, Peabody was a merchant banker in Baltimore, Maryland, at the same time Alexander Brown had just bought stock in the Second Bank of the United States after having been the director of the Baltimore branch of the First National Bank of the United States. Not to say there was a connection, just found it interesting. Peabody, despite all his philanthropy, was known to be a very unscrupulous and mean man who barely paid his employees anything and who most likely left illegitimate children with little to nothing when he died. Speaking of philanthropy, guess where Peabody donated most of his money when he died? You guessed it, education. Since its inception in 1913, the Federal Reserve has always had access to lending to the non-financial private sector in some way or another. From 1913 to 1932, the Fed was rediscounting, aka buying, commercial paper. Commercial paper is simply uncollateralized, short-term debt issued by corporations. While I can't find a paper trail of which private businesses the Federal Reserve was supporting most at the time via commercial paper purchases, we can see Ford's biggest period of growth coming right after the Fed was established. The assembly line was innovated in December 1913, the same exact month the Federal Reserve was established. I wonder if Ford was selling commercial paper to support their operation. I think anybody with a background in finance, such as myself, knows the likely answer to that question. I think anybody with a background in finance also likely has a good guess as to whether or not the Fed was supporting Ford's commercial paper. Henry Ford is even widely attributed with the following quote, "It is well enough that people of the nation do not understand our banking and monetary system, for if they did, I believe there would be a revolution before tomorrow morning." End quote. This commercial paper funding was a very easy way for the Fed to supply liquid capital to business ventures of their choosing. As even acknowledged here by Jeffrey M. Lacker, former president of the Federal Reserve Bank of Richmond from 2004 to 2017. To paraphrase what he said in here for our purposes, with an admitted slight twist, but still holds true, because what he's referring to is credit policy, but if you think about it, obviously applies to monetary policy. Quote, "Federal Reserve banks were given authority to purchase certain types of commercial paper. This highlights the potential to direct funds to particular sectors or particular private entities, either funds they would not have otherwise obtained or on terms they would not have otherwise obtained." End quote. Now obviously that's not exactly what he said, but if we cut out some of the jargon, and if we cut out some of the information that's extraneous to our purposes, we're still left with an accurate summation, even though what he's directly referring to that redirects funds is credit policy and rediscounting commercial paper is technically monetary policy. Obviously, rediscounting commercial paper and monetary policy also redirects funds. And in the context in which he's saying this, it sure seems to imply that what he's saying is credit policy also redirects funds, as well as monetary policy, or just like monetary policy does. And while it's a bit off topic, I couldn't help but notice his language here, as he mentions people clamoring for currency and reserves. I'll just leave it at Ford for the time period in 1913 to 1932. From 1932 to 1957, the Federal Reserve worked closely with the government's Reconstruction Finance Corporation, or RFC. Although the RFC was technically funded by the Treasury, it was dreamt up by a Fed board member named Eugene Meyer, and it occupied office space in the same building as the Federal Reserve Board. At that time, as is now, the Federal Reserve was still printing money and buying Treasury bonds with it, thus financing the Treasury. It appears that companies that received loans and benefited from the RFC include Union Pacific Railroad, Southern Railway, Bank of America, Metropolitan Life Insurance Company, and General Motors. However, if this is true, there's probably more than that. Although one should take this information with a grain of salt, because as you see, it's AI claiming to have a source. I think this data does fit the general concept that we're displaying here well enough for it to likely be true. And as we'll confirm next, this fits the overarching pattern of the Fed's involvement in corporate America. In 1957, the Federal Reserve came up with the idea for the Small Business Investment Company Program, or SBIC. The program was established by Congress in 1958. While the Small Business Administration is labeled as the primary regulator for the Small Business Investment Company, the Federal Reserve has a supervisory role, and it involves examinations and inspections, assessing a financial institution's risk management systems, and tailoring supervision based on the size and complexity of the institution. Some of these supervisory activities granted to the Federal Reserve appear to be subjective in nature. Over the years, the SBIC has funded companies such as Amgen, Apple, Costco, FedEx, Intel, Tesla, and Whole Foods, just to name a few. In 2020, we know the Fed ramped up its corporate lending programs. I don't see a need to visit the details here. I think the point has been clearly demonstrated. But it appears as if a who's who of American corporations all got funding from these corporate lending programs. Remember what happened to the federal funds rate in September 2019? I'm going to ask you to bear with me for the next few minutes here. This is an unscripted portion of the video. I wanted to give an explanation of the relationship between the corporate world and the primary dealers of the New York Fed. So you see here we have the primary dealer statistics. Remember, the primary dealers are privately held corporations. That means they don't have to give us their balance sheets, but we do get statistics from them. As you see down here, we get time series data. What's going to be relevant to us is net positions. This is what they bought minus what they sold, and it's given to us on a weekly basis. So if we come in here, we see different categories. This category here is what they're doing with the federal government in terms of buying government debt. Here we see federal agency excluding mortgage-backed securities. This is going to be a rather small category, so we're not going to worry about it. You see here mortgage-backed securities. That's a rather large category, so we'll take a quick peek at it, although that's not the purpose of this section of the video. Really what we're interested in is the corporate world. We're just going to look at the government business and the mortgage-backed security business that the Federal Reserve primary dealers are doing for comparison to the corporate world. State and municipal and asset-backed securities, these are small categories. We're not going to pay much attention to them. So if we come up here and we look at the U.S. Treasury securities dealings that the primary dealers are doing, we can look at the T-bills here. We see last week they bought 113, and that's billion, because these are all in millions of U.S. dollars. So last week they bought $113 billion worth of T-bills. T-bills are just short-term government bonds that mature in anywhere from 4 weeks to 52 weeks. If we come here to their longer-term government bond purchases, we can see what they did with those last week. I'm going to sum up this week's row quickly off the top of my head. It looks like a total of about $200 billion worth of coupons, and then they bought $100 billion worth of T-bills. So that's about $300 billion worth of government securities that the primary dealers bought last week, more than what they sold. Come down here to mortgage-backed securities. And I don't know the difference between these types of mortgage-backed securities down here. I don't think it's all that relevant to our video. We're just going to take a quick look at it. It looks like they sold more than what they bought of whatever type of mortgage-backed security this is. But then if we come down here, they bought more of this kind, quite a bit more. and then they bought more of this kind of mortgage-backed security and this kind. And then I think if we add all this together, it's going to be close to about $100 billion worth of mortgages that they bought, more than what they sold last week. So now we'll come down here to the corporate world, and we see what the primary dealers are doing in the corporate world is a lot smaller than what they're doing in the other markets. However, it's not immaterial. This is going to have an effect on the corporate world. You see that they bought $12 billion worth of commercial paper last week. That's going to be a lot of funding for certain corporations. Here you see their riskier bonds. Here you see their less risky bonds. And it looks like they're selling more than they're buying of the long-term bonds lately. Something we should note is all of these bond sales could be from one corporation. It could be one corporation that did something that the primary dealers didn't approve of. So this is about $3.5 billion worth of corporate bond sales. Now remember, in our economy, most economic entities, from individuals to corporations to the government, don't have enough money to pay off the debt that they have. And so they need to take on new debt to pay off their old debt that's coming due. And this is going to be prevalent in the corporate world, just like it is everywhere else in the economy. So if this is one corporation and they have this much debt outstanding, then they haven't paid off all their debt. They probably need new debt to pay off their old debt. And if $3.5 billion worth of their debt hit the market last week, it's going to be hard for them to sell new debt because the market's already flooded with their debt. The interest rate that they would have to offer is going to be much higher if there's a sell-off in their debt. Now, like I said, I don't know that this is one corporation, but it's also important to note that this could be the result of more than $3.5 billion worth of corporate bond sales, because they could have bought, let's just look at this column here, the 10-year plus column. The primary dealers could have bought $5 billion worth of bonds last week, yet sold about $7.5 billion, and that $7.5 billion could be all from one corporation or from multiple corporations. But it's important to note that they could really be hurting one corporation or a few corporations who did something that they disapproved of by selling their bonds here. So whoever's debt is being bought by the primary dealers is going to have an advantage, and whoever's debt is being sold by the primary dealers is going to be at a disadvantage. So we see that the corporate world is somewhat subject to the Federal Reserve's will. Subjective will, that is. So when people speak of greedy corporate pigs or greedy capitalists, they're often referring to individuals that the central bank has selected to run an industry. Central banks, or some of their wealthiest stockholders, basically print their favorite industry participant a bunch of money, which said industry participant uses to crush their competition. Sometimes, said industry participant is the central banker. And without that capital, said industry participant wouldn't be set so far apart from their competition, financially speaking, as to dominate their competition and run their competition out of the market. Said participant would almost certainly not be a tycoon, or even close to one, and they wouldn't have the power to continue to abuse the market and its participants, as monopolies and oligopolies naturally do, because there are few to no alternatives to them and their products and services. To really drive this point home, just imagine owning, let's say, a media outlet. Let's say you're a national media firm, and let's pretend you and your biggest media competitors, of which there are many, are businesses all worth about a few tens of millions of dollars. Then somebody approaches you and says, I'm looking for a media company who will run these types of stories and promote this kind of narrative. I will loan them a few $1 billion. Will you be the one to do that for me? If you reject the offer, you're leaving it for your competitors. One of them will now have about 100 times the capital that you do. Now they will be very hard, if not close to impossible, to compete with. So, you take the loan. But 3 of your other competitors get the same offer and also take it. Now you and the 3 other firms dominate the media industry. But your firm and all the other firms are all in debt to the central bank. And in the future, the central bank can make the same offer and up it to $10 billion if it wishes. So now you're stuck in a situation of doing the central bank's bidding or not getting refinanced by the Fed and getting squashed by your competition. This concept applies to any industry that you can think of that the central bank has interest in. And this is how the corporate economy works when there's a central bank. And this operation of controlling corporations can be extended through the central bank's biggest debtor, the government. The central bank tells the government, "We'll let you borrow money again to pay off your old debts, but we want you to use some of the money to give subsidies to a few businesses that will do these things that we want them to do." Google, Tesla, and Amazon come to mind here. It's as if, over time, after compounding interest, the central banking enterprise was able to two-step their operation of corporate control by fraternizing with, or perhaps even subjugating, the governments. One might have noticed that this monetary system coincided with a lot of great economic and technological advancements that have led to our modern lifestyle and high quality of life. However, one could also make the argument that these economic advancements really stemmed from a few other major policy changes that emerged in the 17th century England. These policy changes include the official end of feudalism in 1660 with the Statute of Tenures and the emerging legal definition of private property rights. These groundbreaking policy changes enabled businesses and individuals to accumulate wealth and engage in trade with far fewer restrictions. And while a thorough analysis of the workings and effects of private property rights on the economy is a topic beyond the scope of this video, I do want to assess whether the responsibility of this economic expansion was more likely a result of the new monetary policies or the new private property policies. So, we won't be doing an analysis of all the mechanisms at play in these private property policy changes, such as what we were doing with the monetary market. But something we can look at to help us quickly gauge this assessment are the economic statistics we have from all over the globe from the past few centuries. Now, instead of doing a deep statistical analysis that could take a long time to complete and a long time to explain, I'm going to use Microsoft Copilot to give me a quick assessment. What we'll do is compare GDP per capita growth, which is the most objective economic measure for quality of life improvement, in countries with private property rights to those without, and get the difference between those two categories. Then also get the difference in GDP per capita growth between countries with and without a central bank to see whether private property rights establishment or central bank establishment has a greater impact on GDP per capita growth. But before we get into the data, it's important to note that countries have virtually always had private property rights established before they ever established a central bank. So you see here that when a country has established private property rights, the GDP per capita grows at a rate of about 2% on average if we take the median here. However, the GDP per capita only grows about 0.75% on average when there's no private property rights established. So the improvement private property right establishment appears to have on GDP per capita growth is about 1.25% going by this perfunctory overview by AI, which is admittedly less than ideal. The GDP per capita growth is about 2.15% for countries with a central bank on average, if we go by the median here, and about 1.25 for countries without a central bank, again, if we go by the median. So the improvement central bank establishment appears to have on GDP per capita growth is about 0.9% going by this perfunctory overview by AI, which again is admittedly less than ideal. So the establishment of private property rights appears to increase GDP per capita growth by 1.25% on average annually, whereas the establishment of a central bank appears to only increase GDP per capita growth 0.9% a year on average. So, going by this, private property establishment has a greater positive impact on GDP per capita growth than establishment of a central bank does. Now understand that this is not thorough, comprehensive, or even all that credible of an argument, but it's a good enough indicator for the purpose of this video so we can go back to focusing on the monetary market and not private property rights. But before we move on, there's a little more we can glean from this data. As I'm sure you've noticed, that the establishment of a central bank appears to have a positive impact on GDP per capita growth. But as we noted, the establishment of a central bank virtually always comes after the establishment of private property rights. And if private property rights has a greater impact on GDP per capita growth than the establishment of a central bank, which in turn virtually only happens in countries that have private property rights already established, then we could say that central banks appear to have a dampening effect on the positive impact of established private property rights. This would then imply that central bank establishment really has a negative impact on GDP per capita growth. And while there are potentially plenty of compounding factors that could be influencing this data and making this argument far from comprehensive, this estimated statistical overview should be a good enough indicator to help us with our quick assessment. I think another observation relevant here, although perhaps conjecture, is that economic advancement has a lot to do with ingenuity. To me, it seems unlikely that a small group of bankers and a few of their associates are more ingenuitive than the rest of the population combined. And while an infusion of tax demand capital led to the Harriman Railroads, Carnegie Steel, and Rockefeller Oil, and so on, propelling the economy forward into a new age and improving living standards commensurately, it's far from certain that this forward propulsion would have happened had those individuals, and other individuals for that matter, not had the right to accumulate wealth and engage in trade as freely as they were enabled to do by the private property rights that the world began adopting following England's lead. Also, if the distribution of capital wasn't dominated by central banks and was instead decentralized, other promising projects that could have propelled the economy forward comparatively, and likely then some, in all likelihood would have been able to raise the capital needed to enact such projects from sources other than the central bank. So after putting all that together, I think it's fair to say this economic advancement was more likely the result of free trade and wealth accumulation enabled by private property rights as opposed to central banks. It's interesting that central banks don't seem to appear until after private property rights are established, and as a result, economic growth really starts to take off. This centralized entity that compounds interest doesn't show up until there's a lot of opportunity for the citizens to accumulate wealth that the interest can then compound into. These central banks create something akin to a banking feudalism, but only after property feudalism is abolished and free trade enables wealth to grow within the nation's economy. Credit to famous historian Carroll Quigley for the term banking feudalism. So what's the solution to this problem? Do we go with a tax demand banknote system again, whereby multiple banks can print the tax demand currency? Well, this banknote system preceded the Bank of England in 1694 and the Federal Reserve in 1913. In the Bank of England's case, there were 6 banks issuing England's tax demand currency. In the case of the U.S., there were a few big banks consolidating the monetary power, such as National City Bank of New York, later known as Citibank, and Morgan Bank, now known as Chase. This consolidation led to the Federal Reserve and said bank's control of it. The monetary product these banks were issuing was still uniform and a monopoly, even if the banks weren't consolidated. Therefore, the banks issuing the tax demand currency had a tendency to work toward the same aim with the other banks that would have otherwise been on their same level competitively speaking. So these big banks working together would have been incentivized to limit the supply in order to drive demand for money and interest rates and their profits. And since 100% of the money supply was still coming from banks, the money supply was still being limited because it was only being lent, thereby establishing a perpetual shortage of money relative to the debt. So, if the banknote system isn't the solution, we already covered the gold standard, abolishing bank lending, aka fractional reserve lending, and we already discussed how simply shifting the issuance of national currency from banks to the government doesn't solve the underlying issue. Then what's the solution? What about something like the state bank policy, such as what Andrew Jackson's administration began in 1837, whereby state banks issued the tax demand currency for each state within the country, a monetary policy that remained in place until 1863? Well, that just creates a lot of smaller, statewide monetary monopolies, while also creating a limiting situation in which it becomes impossible for any currency to reach universal acceptance within the country, complicating the situation more than necessary. And universal acceptance should not be confused with uniformity. Uniformity is necessarily a monopoly, whereas universality is not necessarily a monopoly, as we'll touch on here soon. So if you've never thought of it, or really considered it, the solution may seem extreme, although I believe we've already proven to the contrary that our current system is what is extreme. The answer lies in establishing a monetary market rooted in freedom of choice. It should be competitively fair to all forms of currency, whether private or public. This can be attained by legalizing every type of monetary product and ensuring that private currencies aren't taxed. This economic system would maximize the economic benefits for all individuals and businesses, and it would also minimize the costs, which in this system is interest. One of the benefits of the solution would be a new capital market. Private vouchers could be used to raise capital for businesses. Businesses could issue vouchers backed by whatever their business sells, likely a commodity. These businesses could sell these vouchers in lots to customers and investors for a more widely accepted currency, maybe a universal currency, such as a national currency, or maybe gold. We'll discuss what a universal currency might look like in a free market here shortly. These vouchers could provide a discount for the product backing them. From the investor's perspective, these vouchers, in essence, would start off with the same utility as a coupon, or something similar to a reward system for customers. Since these vouchers can be issued in lots, they can be used to raise capital as opposed to generating sales like what a reward system and coupons are used for. Now, this does not mean that this business could or would only accept this voucher. They would still likely accept a universal currency and whatever other monetary products they see fit. The customer would have the choice of using the universal currency or one of the other currencies the business accepts. In said business's new private voucher could then possibly gain traction at other businesses. Perhaps some firm that's doing business with the issuer of the voucher decides it's a good idea to accept the voucher for payment as well, so they too can get the discount. This voucher could even then continue gaining further traction and start to circulate like a currency. As the demand for this new monetary product grows, the value goes up. And because the value increased, there's more incentive to increase one's supply of said currency, and even the issuer is incentivized in this manner. So even the issuer will want to increase their supply. And there are two primary ways for the issuer to do so. One, to issue more, aka inflate their currency, and two, to start accepting it at a steeper discount, since it is now more valuable because it is accepted for more goods and services. As long as the issuer leans more toward accepting it at a steeper discount, the early investors see the value of their voucher investment increase. If the issuer starts inflating it, it may benefit the business and its owner more, but that also increases the risk of the voucher losing acceptance and therefore purchasing power. This risk would increase in proportion to the amount the voucher's supply is increased. And in this system, there could and would be multiple currencies competing in the monetary market, which is further incentive to not inflate your currency. Let me give a concrete example of how this could work. Imagine a scenario where a coffee shop wants to expand their business by offering high quality espresso. Let's say they want to get a really high quality espresso machine, but they don't have the funds yet and don't want to take out a loan or sell their equity. This business could sell vouchers that are good for a cup of coffee, but only in lots of 1,000 at a time. By selling the vouchers in lots, they're more so raising capital than offering a sale. These vouchers are good for a large cup of black coffee, but are sold at 20% off of the list price of a cup. Note, to simplify things, these vouchers could be denominated in the universal currency as well, instead of the coffee. We'll give an example of that next. But to continue with this example, let's say these particular vouchers don't expire, so a customer/investor could have 1 cup of coffee each day as per their usual for the next few years, and in the end, save 20% on their coffee. With the capital the coffee shop just generated, they can get a new espresso machine. Now imagine the bakery down the street, who's already doing business with a coffee shop, decides it's in their best interest to accept this voucher. Maybe the bakery accepts it at a 10% discount for its products, splitting the difference with their customers. Then the grocery store, who's doing business with the bakery, starts accepting it as well. And now, since most people shop at the grocery store, it makes sense for just about anybody to accept it. Sure, it might entail a little extra math for businesses to figure the voucher's value in relation to the universal currency, but it's not that complicated. It's not more complicated than a coupon or a reward system, and to some, it might be worth it. To everybody else, they can just stick to the universal currency. Now, with the voucher gaining wider acceptance, and thus demand, the value of the voucher has increased. The owner of the coffee shop can even take their monetary product to the grocery store and get groceries with it. What does the owner do? She considers printing just a little more, just for herself, to get groceries with it. But then she realizes that just inflating it might upset some of the accepting businesses, causing them to stop accepting it, hurting the voucher's demand. So she also starts accepting her voucher at a greater discount. Now she starts accepting the voucher for an extra large cup of coffee, not just a large. This should make some of the accepting businesses happy, even though she's printed more and increased the supply, and it should also create more incentive for her customers to spend it back to her at her coffee shop. And if you think about it, the grocery store accepting it should have created enough demand for her to both increase the supply and increase the discount. And once the coffee shop starts accepting it at a greater discount, then the bakery and the grocery store are all incentivized to do the same thing. And this increased discount further incentivizes adoption at more businesses. Also note, when the grocery started accepting it, that was also incentive for the bakery to increase the coffee voucher's discount at its store. Another thing that happened during all this voucher adoption is the investors in this private coffee-backed monetary product just saw their purchasing power and wealth increase. All this monetary innovation created wealth, prosperity, and perhaps even a sense of community. And this could be done in many different ways. The coffee vouchers could be denominated in the universal currency, then accepted at a discount, instead of denominated in coffee and sold at a discount. This could give the voucher issuer more flexibility to increase the discount if and when it makes sense. Let's say the dollar is the universal currency in this imagined scenario. A large cup of black coffee at the same coffee shop is $5. The coffee shop owner could sell the vouchers in lots of 2,000 for $2,000. She could then say a large cup of coffee costs $5 or 4 of her vouchers, giving the voucher investors the discount like that. However, if the sale of coffee in exchange for vouchers is considered taxable income, taxable revenue, or taxable business in general to be paid in dollars or whatever fiat applies to you, then the amount the coffee shop's dollar holdings go up won't be commensurate with the amount their tax liability goes up. So that when taxes are due, instead of having the dollars needed for taxes, they may have too much of their cash tied up in their vouchers. They might even have to issue and sell more vouchers for dollars, if there even are any buyers left to make it possible for them to do so they can get the dollars needed to pay their taxes. This would inflate their currency, hurting its ability to compete in the monetary market. However, if the coffee shop owner went to the bank for a loan and acquired capital that way, she wouldn't have to pay taxes on it. If she were to issue some stock and raise capital that way, she would not incur a tax liability on that either. Why are monetary products the only form of capital that triggers a tax liability? This is why we never see vouchers circulate like currency. And this idea of private vouchers being used to raise capital makes more sense as you go back to supply chain. For example, here, a coffee bean supplier. But I digress. And now let's look at it from the bakery's perspective when tax demand currency laws are applied. The bakery also has to record the sales made for coffee vouchers as part of their income, which is taxable in US dollars, or whatever fiat is applicable in your country, and also pay the sales tax in US dollars. While the bakery is less likely to not have the dollars needed for income taxes than the coffee shop, because the bakery probably won't do as many sales and vouchers as the coffee shop, it's still a possible concern for the bakery. Moreover, the bakery notices the high risk this poses to the coffee shop, which makes the bakery less likely to accept the coffee voucher in the first place, because they know that the coffee voucher will either need to be inflated or sold off in large quantities to pay taxes. This observation is enough to keep the voucher from gaining further acceptance. So this tax rule renders vouchers and other forms of monetary products unable to compete as a form of currency with the tax demand currency. I'd love to see what would happen if these laws were made fair to all private monetary products. There should be no taxes on any private currencies. At best, one could argue the sale of the voucher, if sold for the national currency, could incur a sales tax equal to all other taxes, and that would be fair because the business is leveraging future sales of their product and using the national currency to do so. But one could then argue that a loan is a sale of debt and should incur a sales tax for the same reasons, and that the selling of a stock is leveraging future income and should incur an income tax or a sales tax, since sales are what will generate the income. I'm not going to go too deep into the tax nuances of stocks and bonds here and all the implications, but I think you see where I'm going with this. Why does debt and stock get to have a tax advantage over currency in the capital markets? Because a monopoly on the monetary market is basically a monopoly on the rest of the economy. And a monetary monopoly is obviously the intent of the laws that make tax demand currency when you consider that even bartering is taxable in USD. Now, the reason I don't see a need to go into the stock and bond tax nuances is because if there is simply no tax when the national currency is not used, you give the vouchers an ability to compete. This is fair because the national currency was not necessary for the transaction. Even if the initial sale of the voucher for the national currency is taxable at the same income tax rate and sales tax rate that everything else is taxable at, if the transactions with the voucher that incur after that are not taxable, this lack of taxes contrasted with the national currency would make up the competitive ground lost by the initial tax. Because while the initial cost of the voucher issuance may be high due to taxes in this given situation, the competitive advantage the voucher has for its use after that would be proportional to how high the tax is on the initial issuance of the voucher, since the tax on the initial issuance is equivalent to how much more you would have to pay taxes afterwards when using the national currency versus using the voucher. So, if the government were to maintain an overly aggressive taxation on the initial sale of a voucher for the national currency relative to other capital markets, but forego trying to tax all future uses of the voucher as a form of payment for goods and services, then it would only take a few, maybe even one, voucher to gain traction before future new voucher issuances that are done by different companies would be done in exchange for already existing vouchers instead of the national currency, because these already existing vouchers would have gained traction over the national currency because the competitive advantage they would have for not incurring a high tax like the national currency does in this situation. So, again, assuming that the taxation on the initial sale of the vouchers is equal or equivalent to taxation on all other goods and services in the economy, then you'll have a counterbalancing effect on any overtaxation that might prevent the first private monetary products from getting started. And this is why I'll keep my argument to simply no taxes on private monetary products, aka abolish tax demand currency, instead of getting deep into the specifics of the taxes. And even though the Fed is privately owned, I don't consider any tax demand currency to be a private monetary product, because its use is forced by the government. Now, I understand some thoughts viewers may have. It may seem chaotic, confusing, or may even seem to increase the risk for scams. You might see it as a risk to national security. Initially, I can see why you'd think that. However, these assumptions are flawed. First of all, if you think there will be scams in this market, just remember that our current market is one big scam. 100% of the monetary market is akin to a Ponzi scheme. If monetary products were subject to competition, it would be harder to pull off a scam in the market because you would have options and would tend toward the more trustworthy options. And the suppliers of the monetary products, who are thinking more long term, would have incentive to be trustworthy. And this proposed open monetary market isn't chaos. You might imagine varied currencies getting rejected at businesses, complicating trade, making it as inconvenient as bartering. But this won't happen. To assume no monopoly equals no universality is flawed. A universal currency will exist that nearly everyone accepts, with businesses offering additional options. If the government acts properly and its currency holds value, then the national currency will be the universal currency. If not, gold or silver might be. Perhaps the national currency and gold or silver could both be universal and both be accepted virtually everywhere. However, if I'm wrong and the universal currency does not emerge naturally, it must not be very beneficial to the human condition. Let me explain. The universal acceptance of a currency has its own benefit because knowing the currency will be accepted anywhere is rather convenient. And if a universal monetary product does not exist, then sub-universal yet widespread acceptance has its own benefit. Because if knowing your money will definitely be accepted everywhere is not an option, knowing it will very likely be accepted anywhere is relatively convenient. So if the idea of the universality of money has benefit, and widespread acceptance of a currency also has its own benefit, then it's fair to assume that the breadth of which a monetary product is accepted also has its own benefit, because of its relative convenience. If the breadth of which a monetary product is accepted has its own benefit, then that breadth will incentivize further continued acceptance, expanding said breadth. In this way, acceptance of a monetary product will beget more acceptance of the same monetary product. This will continue until the monetary market has provided a monetary product with universal acceptance, assuming universal acceptance indeed has benefit. To make this more clear, just imagine being a business owner in a non-universal currency environment. You naturally want to accept a popular currency to attract and keep customers. So you see, whether I'm right or wrong about a universal currency naturally emerging, the result will be a reflection of what people find beneficial. Another important point to make is that businesses refusing the universal currency can still operate even if it harms them. Likely, they will lose customers, which in turn would likely run them out of business, making such business practices unsustainable. Now, once a particular monetary product has reached universality and virtually everybody is using it, the demand for universality is met, and it's possible for any subsequent monetary products to stop gaining universality. This does not mean there can't be more than one universal monetary product, but explains why there may only be one and not multiple universal monetary products. If you're a business owner and you see a growing trend, but a universal currency already exists, your pressure to adapt reduces. So, the tendency of people to adopt a universal monetary product should have addressed some of the perceived confusion within this proposed monetary system. Now it should seem no more confusing to you than coupons, rewards and point systems, or stocks. Quite frankly, it's less confusing than our current debt-based money. Think about how confusing it was earlier when I was explaining all of that to you. And you can choose to participate in this proposed monetary system to any degree that you like. From the simplest, which would be only using one universal currency, to having a diversified portfolio of all kinds of currencies. As for the question of national security, this leads us directly into the next topic, and by the end of it, we'll circle around to answer that question. Another benefit of this monetary policy is that it keeps the issuer of the national currency in check. If the national issuer starts spending money frivolously, or issuing money for things the population generally does not agree with, then the population can sell the national currency and divest into private currencies as a matter of pragmatic wealth protection or as a matter of protest. On the flip side, if the government is doing a really good job making smart decisions in how they issue their currency and acting in a way the general population finds agreeable, this will increase the demand for and value of the national currency. In this way, the government's worth and merit will be reflected in the value of its currency. Now, some might worry that this could quickly lead to dangerous anarchy, because why would anybody use the taxable currency over the non-taxable currencies? And if everybody decides to stop using the national currency, it would lose all of its purchasing power, and the government would have no power, so there'd be no government. So let's take a closer look at that concern. First of all, if the government issues just enough money to keep pace with a growing economy, meaning that a given amount of money is chasing a given amount of goods, then it's possible that the government could fund its operations without taxes at all and do so without inflating its money. And if the government increased the money supply at a lower rate than economic growth, then the value of the national currency would tend to increase. The government could simply print and spend new money based on the economic growth and fund its operations like that. Although it should be noted that it's not simply the economic growth that accommodates new national currency supply. It's the government's monetary market share times economic growth, because some of the economic growth could be captured by the private monetary market. Remember, money is good in exchange for all the other goods and services. So if the wealth grows, so does the value of the monetary market. If the value of the wealth in the economy grows 5% and the private monetary market value grows by 3%, then the government's currency grows by 2%. If the government then increases their money supply by 1%, then the value of the national currency should increase by about 1%, aka deflate by about 1%. Now this assumes that the velocity of money, which we discussed earlier, will be stable. And over time, the velocity of money should be stable. So I don't want to digress too far into the discussion of velocity of money here. And if the government does tax their monetary product, that doesn't automatically mean it will lose out to its competitors. The government may have enough value and merit to justify its tax to the marketplace, whatever that tax may be. On the flip side, if governments prove incapable of acting in the interest of its citizens, thereby rendering its currency worthless and government impotent, then does that not mean anarchy must be a better option anyway? Are you starting to see the balance emerging here? The government will grow and shrink in proportion to its merit if it's held in check by a free, private monetary market. Now, I don't personally have a solid opinion on anarchy, but if it does happen to be true that governments are not capable of acting in their citizens' best interests, and anarchy is indeed for the best, this policy change would not only prove the anarchists right, but it would be the most feasible way, if not the only way, to achieve anarchy in the first place. Assuming, indeed, government is incapable of acting in its citizens' best interest. Anarchists trying to abolish the government without removing the monetary monopoly is like trying to remove a weed with a pair of clippers. The money power is the root. The government stems from the money power. And if the government does have enough merit to act in its citizens' best interest, then this policy would prove the anarchist thesis wrong. Just to complete the analogy, the government then would prove to be a beautiful flower, not a weed. Personally, I hypothesize that the government is capable of acting in our best interest, but only if held in check by free market competition. I think this free monetary market policy would shrink the size of the government relative to the rest of the economy, but the government, of course, in this circumstance, would be beneficial to the people and strong enough to serve its purpose. However, in regards to this hypothesis, there's really only one way to find out. I'm open-minded about the anarchist thesis, and I'm interested in seeing if their thesis is correct. It's kind of funny. It's widely accepted that monopolies are a bad thing, but everybody overlooks the monetary monopolies that dominate the global economy. Now, perhaps you've thought of the counterfeiting issue, but quite frankly, this is a risk to tax demand currency as well. Counterfeiting affects all currency, not just one producer's product. Everyone should have a chance to innovate solutions. It's only fair to allow everybody who wants to give it a try to see what kind of creative solutions they can come up with for their monetary products. Solutions to counterfeit have been as simple as tally sticks or as complicated as cryptocurrency. Leave it to the investor to decide if the counterfeit risk mitigations are viable. By the way, cryptocurrencies could be the vehicle used for vouchers if the government wasn't taxing payments made in cryptos with fiat currency. The final objection to the free monetary market solution I see worth addressing would be that of the national security. The same principles are going to apply here. If the government is reduced or non-existent, how will the people defend themselves from threats? Well, some of the government's merit lies in its ability to defend its citizens from foreign threats better than the people can defend themselves. If a nation is being threatened by foreign invasion, beyond what the people can defend themselves against, but not beyond what the government may be able to handle. A safety trade would ensue. People would see the private currencies as less likely to survive the new environment and sell the private monetary products for the national monetary product. This would give the government more power to help defend the country. Moreover, a population who has achieved, through the balance of monetary power, their maximal liberty and prosperity is probably not a population any government, foreign or domestic, would want to mess with. One might argue, isn't maximum liberty and anarchy one and the same? Not if anarchy results in something akin to gang rule. That's not liberating for most people. Not that I'm concluding that anarchy would or wouldn't lead to gang rule. Now, on the flip side of that argument, it's by definition not maximum liberty if the government is overreaching either. So this balance of power that the free monetary market provides also maximizes freedom by forcing the government to prove its worth, and by balancing the size of the government with the government's level of merit. And this level of merit includes the government's tendency to diminish gang rule and to diminish other crimes of force, deceit, or imposition. And also included in the government's merit is the government's tendency to reduce the risk of foreign threats. Therefore, this policy minimizes the general imposition placed on the citizens or people of a country. And if we consider imposition to be the antithesis of freedom, which I think is fair enough, then this monetary policy leads to maximum liberty. Another benefit private monetary markets provide is market stability. Almost every currency throughout history ever has died. The few remaining currencies are the vast minority of all currencies to ever exist. And in the event of a collapse of a major currency, it is less volatile and less chaotic if there are other viable currencies ready to take the dying currency's market share. If one currency goes from having 100% of the market share to zero overnight, then all of a sudden there's no currency at all. There would be no measure of value, no medium of exchange, pure chaos, until other monetary products are created and can make up for the 100% collapse in the monetary market. But if the universally accepted currency only has, let's say, 60% of the market share, and it goes to zero overnight, yes, a lot of people would lose a lot of money and a lot of wealth would be destroyed. But not as many people would lose everything, and not as much wealth would be destroyed as would be if the dying currency had gone from 100% of the market share to zero. And because there would already be other viable currencies, in short order, the existing viable alternative currencies would be able to step up and fill the void left in the monetary market. A 60% crash with a built-in recovery plan that is ready for immediate implementation is more stable than a 100% crash that doesn't have a recovery plan at all. And by the way, the 60% of the market share that we used in this example is just an arbitrary number. I have no idea what the universally accepted currency's market share would be. The market would also be less subject to the national currency's volatility or any decrease in the national currency's value, because other monetary products could provide a more stable option, forcing the national currency towards more stability, and by reducing the impact of the national currency's volatility on the market by reducing the national currency's monetary market share. Another benefit of the solution would be the decentralization of industry via the decentralization of capital markets, which are what formed the megacorporations, which in turn formed these monopolistic and oligopolistic industries. By allowing local and small businesses access to venture capital, a market they didn't used to have access to. They can better compete in these oligopolistic and monopolistic industries, which were initially formed by virtually unlimited funding from the centralized capital markets, controlled by the monetary monopoly. Sure, these mega corporations could also create their own business vouchers, but access to capital created in the monetary market is still more decentralized in this proposed monetary market solution than in the current monetary system. I think the free monetary market is the ultimate solution. Once people grasp its power and the liberty it provides, it will become second nature. Imagine issuing your own currency alongside others. The community thrives with private currencies circulating, fostering wealth and prosperity. The more risk averse abandon national currency completely, while most diversify their portfolios. Government overreach is a thing of the past. Then, the government demands taxes to be paid on transactions done in private currencies. Those benefiting from this market, which is basically everybody in the economy, see the impact clearly. The new tax rule would end competitive monetary alternatives, threatening their prosperity and freedom. People would resist, and tax collectors would be unable to enforce compliance. The prosperity it fosters empowers citizens to fight against tyranny. The result of this attempted government encroachment would be a sell-off in the national currency. But the government would already know this and would not even try. A free currency market is the ultimate freedom. It preserves and protects all other freedoms. Unwarranted or untruthful government propaganda would lead to sell-offs in the national currency. Any attempt at censoring the truth, same result. Fiscal, monetary, or regulatory favoritism in the marketplace, you get the picture. Poor policies or unjust wars, once again, currency sell-off, making all that nonsense impossible to fund. However, immediate threats to national security that the government is most prepared to deal with make the national currency more attractive relative to private currencies, causing a safety trade into the national currency, thereby enabling government action against the immediate threat. To free market advocates, a free market requires a free monetary market. Can a market truly be free while forcing a specific currency on everybody? No, obviously not. That contradicts the definition of free market. The monetary sector, being worth half the economy, shouldn't be monopolized. Believing in a free market with a tax-driven monetary monopoly is self-contradictory. Critics claim the free market fails, but in reality, it hasn't even been tried because all throughout history, economies have been dominated by tax-driven monopolies. Such a system doesn't qualify as a free market. Calling the economy free while forcing people to use and subjugating people to tax-driven money is a misnomer. And the practice of making half of the economy fascist in nature, while having the monopolies debtors in education, media, and other informational markets, and the government proclaim it as a free market, has been used as a guise by the economic monopoly, aka the monetary monopoly, to make people think a free market cannot work, and to make people think a free market only serves the greedy corporate pigs, when in reality, it was never even close to a free market in the first place, and greedy corporate pigs were a result of the fascist monetary system. This guise is used, of course, in order to deceive the population in a way that preserves the monetary monopoly by making people think freedom is bad and by distracting people from the real problem, which is, of course, the monetary monopoly. So, in conclusion, the central bank is the house, which makes everybody else the speculators. Unfair tax demand has enabled a monetary monopoly, which is manifested as central banks to take nearly complete control of the global economy. This will cause economic calamity that will most likely occur sooner rather than later. This oppressive monetary monopoly is extremely dangerous to all of humanity and a violation of our natural liberties. And so, we should choose to use our money, not have to use the money.